Dear students, we first consider the expenditure approach. We first consider the expenditure approach to the measurement of national income. In business accounting, a basic financial statement is the balance sheet. Balance sheet is the basic financial statement. And in the balance sheet, assets are placed in one side, liabilities are placed in the other side. Assets and liabilities. In national income accounting, an equally basic statement is national income and product account. National income and product account. In national income accounting, the basic framework is, the basic statement is national income and product account. Various income flows are listed in one side. Income flows are listed in one side and various product flows are listed in the other side. Income flows in one side, product flows in other side. Like the balance sheet, two sides of national income accounting, income flows or product flows, will give you the same total. You will get the same total as in the case of a balance sheet. Asset and liability side always balance. Similarly, income and product sides always balance. So we can estimate the value of output either by totaling the value of all goods and services produced or by totaling the income generated when producing these goods and services. By totaling the value of goods and services produced or by totaling the income generated in the process of producing these goods and services. Now, estimation of national income from the product side is known as expenditure approach. Estimation of national income from the product side is known as expenditure approach, and estimation of national income from the income side is known as income approach. Income approach. So, national income is either a product flow or an income flow. But to calculate it from the product side, we use expenditure approach, and to calculate it from the income side, we use the income approach. Remember these points very carefully. Then only you will understand various concepts associated with the national income accounting later. Now, one way to arrive at economy's aggregate output of goods and services at any time is get the number of units of each goods produced multiplied by price per unit of each good. Add it together, that is the total. That is, if the economy produces n goods, multiply the quantities of these n goods with the prices of these n goods, add it together, you will get the total. But calculating national income by this procedure is a very formidable task. It's not easy to obtain such a measure. The easy method is count the value of each unit at the time it is purchased. in the market at actual purchase price and add together expenditure on each good and service at the time when it is purchased, and you will get a total. You will get the total, and that total is calculation of national income from the product side. And it is known as the expenditure approach because we calculate national income when it is purchased by the consumer in the market. That is, total quantity of each commodity purchased multiplied by the actual price in which it is purchased by the consumer, that will give you the total. But this approach, that is the expenditure approach, require some refinements. Let us see what are the refinements required. One is this total must consist of only those goods and services produced during a given time period. Because national income is defined as the money value of all final goods and services produced in a country during a given time period. So we consider only expenditure on goods and services produced during a given time period. So expenditure on goods and services produced in a different time period is not considered here. So we exclude expenditures on goods and services produced earlier in a previous year or 2 years back, etc. That is one refinement. The second is we should exclude expenditures on anything that is neither a good nor a service. Expenditure on anything that is neither a good nor a service. For example, expenditure on, say, stocks, bonds, etc. If we spend money to purchase stocks, shares, etc., whether issued in the current period or in the previous period, this expenditure is excluded because there is no corresponding output of goods and services. Remember this, we are using the expenditure approach to calculate national income from the product side. So exclude expenditures on purchases of stock, shares, etc. The third is we exclude expenditures of central, state and local governments for which government receive nothing in return. Government spends money but nothing is received in return. Example, government expenditure on social security, unemployment compensation, veteran benefits, etc. For those expenditures, government receive nothing in return. Social security, unemployment compensation, veteran benefit, etc. We call such as transfer payments. Transfer payment is a payment for which nothing is received in return. Such expenditures are excluded while calculating national income using expenditure approach from the product side. Similarly, we cannot include all the remaining dollar amounts spent on goods and services produced during that time period because such a total may count some goods or services once, twice, thrice, etc. So you will spend on same good and service more than one time and you will overestimate the total output. So we include only expenditure which is regarded as expenditure on final product. Expenditure on final product. That means expenditure on intermediaries are not considered. We consider only expenditure on final product. That is, exclude expenditure on output, although produced during the same time, is used up in the process of producing other goods and services. Such excluded output is known as intermediary. So expenditure on intermediary is excluded. We will not include expenditure on intermediaries. A classic example is wheat, flour, bread. Only bread is the final product, so we consider only the expenditure on final product. We will not consider expenditure on flour and expenditure on wheat. This is because expenditure on these items will be included in expenditure on the final product bread. So we include only expenditure on final goods. This is to avoid a problem known as double counting. Double counting. So the method used for calculating national income to avoid the problem of double counting is either we use the value added method or we use the final goods method. Either you add only expenditure on value added or you use only expenditure on final goods and services, because the definition is money value of all final goods and services. So we consider only expenditure on final goods and services. Otherwise, you will overestimate the true national income. Now, the reason for excluding expenditure on intermediate product is clear, but it is very difficult to determine which goods and services are final and which goods and services are intermediary in special cases. As an example, many government purchases lie in the gray area, whether it is spending for final goods and services or whether it is spending for intermediary goods and services. As an example, if private sector cannot operate without government expenditure, it is an intermediary product. Expenditure on purchases by the government is expenditure on intermediary. If we think that these services exist independently without any relation to the operation of the private sector, then it is expenditure on final product. As an example, consumption expenditure for transport from and to the workforce, medical care. Whether these are intermediary or final is a question of doubt. You consider the services of police, whether it is intermediary or final. If a private sector cannot operate without this police service, it is intermediary. But if police service exists independently, then it is expenditure on final goods. So, careful consideration, case by case consideration is required to determine which expenditure is final and which expenditure is intermediary. So, in the expenditure approach, we exclude these types of expenditures. And expenditure approach calculates national income from the product side as expenditure on goods and services. So it is nothing but calculation of national income from the product side as expenditure on goods and services produced. That is why it is known as expenditure approach. The other approach is income approach. Whether you use this or this, you will get a total and both will give you the identical value for final output or aggregate supply or national income.